Stock market basics. What are stocks? A stock is a share in the ownership of a company. Stock represents a claim on the company's assets and earnings. As an owner, shareholder, you are entitled to your share of the company's earnings as well as any voting rights attached to the stock. Why do companies issue stock? At some point every company needs to raise money. Companies can either borrow it from somebody or raise it by selling part of the company. By issuing stock, the company does not have to pay back the money or make interest payments. What does the shareholder get out of the deal? The shareholder gets the hope that the shares will be worth more in the future. If the company does well, the stock will probably increase in value. If the company does not do well, the shareholder may lose the money he or she invested. What's an IPO? IPO stands for Initial Public Offering. It's the first time the stock is available to the public to purchase. The stock exchange itself is a secondary market. The primary market is the brokers. What is a dividend? A dividend is money that a company pays to its stockholders from the profits it makes. Not all companies pay dividends to their stockholders. The only way shareholders in these companies make money is to sell the stock at a higher amount than they bought it at on the open market. What is the difference between common and preferred stocks? Common stock is the type most people purchase. It represents ownership of a company and a claim on part of the profits. Investors get one vote per stock. Preferred stocks don't have the same voting rights, but investors are usually guaranteed a fixed dividend. If the company is liquidated, they are paid off first. How do stocks trade? Most stocks are traded on exchanges such as the New York Stock Exchange or NASDAQ. The NYSE is a physical location whereas NASDAQ is a virtual market. In India, BSE and NSE are stock exchanges. Exchanges are simply places where buyers and sellers meet and decide on a price for a stock. Think of it as a flea market where buyers and sellers come together and agree on a price for a product. The NASDAQ Exchange. NASDAQ is a virtual market called an over-the-counter, OTC, market. It has no central location or floor brokers. Trading is done through a computer and telecommunications network of dealers. These market makers provide continuous bids and ask prices within a prescribed percentage spread for shares for which they are designated to make a market. They usually maintain an inventory of shares to meet demands of investors. Is the United States the only country with stock exchanges? Absolutely not. Many countries have stock markets. The two other main financial hubs are the London Stock Exchange and the Hong Kong Stock Exchange. What sets the prices on a stock exchange? Market forces changes stock prices every day. Share prices change because of supply and demand. If more people want to buy a stock, demand, than sell it, supply, the price goes up. If more people want to sell than buy, the price goes down. What makes people want to buy one stock and not another? The price of a stock indicates what investors feel a company is worth. The most important factor that affects the value of a company is its earnings. Earnings are the profit a company makes. Public companies must report their earnings on a quarterly basis. If a company has done well, the stock price will likely rise. If not, it will drop. In review, stock means ownership. You can lose all of your investment with stocks. The two main types of stocks are common and preferred. Stock markets are places where buyers and sellers come together. Stock prices change according to supply and demand. Bulls make money. Bears make money. Chickens sit on money. Pigs just get slaughtered.